Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the couple of disclaimers I need to check out for you, I'll just run through some of the key objectives that we hope to get through and outline of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is to break down all the market jargon and complexities that we read about. So if you do have any questions, please do ask them along the way, or write them in the box, and I will hope to answer them as soon as possible, or at least after the webinar finishes. Okay, it's Wednesday, the last day of July 31st, just after 11 a.m. in the UK. So let's get to it. I'll firstly just check out how markets are shaping up currently, and then we'll get into the meat of the webinar. So we'll just actually look at some of the stock mega cap tech earnings which have come out and are coming out this week. Big influence on the markets, of course. So we'll just briefly touch upon those. Didn't mention those in the preview, but we will. Before then, looking at the eurozone inflation data that's just come out, as well as the Bank of Japan meeting. Really important meeting, we think, for the yen, potentially for markets as well. Before then, previewing the Fed, tonight's Fed meeting, of course, as well as tomorrow's Bank of England meeting. And then finally, after all of that, this week, a really hectic week to kick off August really and end July, we have the non-farm payroll report, of course, as well. So we'll preview that, as well as all the associated major currency pairs. So I'm just checking out, first of all, just where markets are currently. Tech stocks obviously have dragged down indices overnight in the US amid really a chip sector slump. The Nasdaq 100 actually hit 2-month lows. Currencies, well, the yen is certainly whipsawed really following the Bank of Japan decision to hike rates to 0.25 basis points or so. Initial reaction, which we'll get into in more depth shortly, did actually move higher dollar yen, so the yen weakened, but then really on the back of the announcement around JGB purchases. But then after the Governor Ueda press conference, he was certainly more hawkish than many thought, and dollar yen has gone south through a huge level, which we'll look at shortly, 152 in dollar yen. So the yen has strengthened, with potentially more hikes to come this year. Commodities, gold and crude, they've received a small bid really as Middle East tensions grow. Just watch out for that. In amongst all the central bank meetings, of course, we still have those geopolitical tensions in the Middle East, sadly, to be wary of. Tuesday on bond markets, well, that was pretty volatile due to, of course, those tensions. So the Israeli strike, retaliatory strike, they're calling it, really impacting yields, with treasuries going lower now. 10-year treasury, certainly one to watch as that goes lower. In amongst, of course, the Bank of Japan raising interest rates. Of course, today we have had the Bank of Japan, we've had the Aussie CPI data slightly, well, the core measures, or one of them was slightly more in line, not as hot as expected, essentially, that data. So potentially means the RBA don't raise rates next week. That was key, that data, and potentially the rate hike odds have been reined in slightly. We do get, as I say, Fed later on today, as well as Meta's results. Just checking out then these mega cap tech earnings. First of all, I'll just pull up the chart for the Nasdaq at least, which you can see here. Looking at the sort of Magnificent Seven as a whole, really, I guess, so just recapping on that, for the so-called Magnificent Seven, they have really powered the US market rally for the past 9 months or so. They ended last week in correctionary territory, having fallen by more than 10% from recent peaks. So Nvidia and Tesla, they're down. They were down around 17% at the start of the week from their recent peaks. That is Meta and Google, parent Alphabet, they have fallen again, start of the week 14%, 12% or so, with Apple being the best performer of the group. That lost around 7% again at the start of the week, although that's probably moved lower now, with Microsoft and Amazon sliding, well, just below correctionary territory at the start of the week. But certainly Microsoft now looking pretty grim, slated to open down around 6%. I think last time I looked after its results released overnight last night. I'll get to those shortly, but really investors are looking ahead to these tech earnings updates, really amid worries about quite punchy valuations, really, and the risks that returns from, of course, the vast AI related spending may really not live up to early hopes. And really interesting now, we're getting more commentary from investment banks, certainly, and other analysts about this overspend in AI and whether it will bring the benefits, productivity benefits and cost benefits really that initially were hoped for. Just on that, Alphabet, of course, last Wednesday, they sparked a wider market sell-off really when, despite reporting solid quarterly operating numbers, its shares fell more than 5% on concerns about those AI-related investments. Its $13 billion quarterly capex, capital expenditure, that is, was almost double the levels of a year ago. So markets really punishing those that miss or disappoint really, and Tesla, again, a prime example, off I think around 12% after its results, basically slowing sales, and then AI spend shrank profits more than expected. On average, companies that missed expectations have seen shares fall over 3%. That's higher than the 5-year average of just over 2%. And then companies that beat saw on average virtually no gains. That is according to FactSet. And then also, of course, we've seen this rotation into small caps. The Russell 2000 really benefiting last week, for example, up 3.5%, whereas there was a 0.8% loss in the S&P 500. And we'll get onto this shortly, just around this unwind of the yen carry trade being a big reason why we're seeing profitable trades now being taken off. And that relates to tech stocks, of course, growth stocks, and then this switch into smaller caps because of potential for a Fed rate cut in September, of course, and then as well, other trades like gold being taken off the table as well, although there is an underlying big because of the geopolitical tensions. Microsoft, as I said, I'd touch on first of all. They reported earnings overnight, Q4 earnings beating overall revenue estimates, but then missing on cloud revenue. And that led to a drop, as I say, of around 7% in after hours, 6 or 7% in after hours on the earnings release. Interestingly, we had AMD, Advanced Micro Devices. They posted a decent beat, Q2 earnings surpassing expectations, releasing strong Q3 revenue forecasts, which then boosted shares actually in after hours. For this week, then we do get Meta later after the close, US close today. They've been up around sort of 30% or so. Let me just pull up that chart actually, first of all, just briefly to touch upon these guys. Owner of Facebook, of course. Yes, stock has been up around 32% or so this year. So not only one of the best performing stocks in the S&P communication service sector, but the 23rd best in the index overall. I think options, they imply a move on the results of around plus or minus 8% or so in the 24 hours following the quarter earnings release, so just watch out for the volatility there. And for consensus expectations, well, Q2 sees EPS at $4.74 on revenues of $38.3 billion. We then get Amazon and Apple reporting after the closing bell, that is, on Thursday. Tomorrow, Amazon, that's traded up around 16% or so this year in 2024, so outperforming the S&P, of course. stands around the 4th largest single stock in the S&P 500. And is also a Dow constituent, don't forget that. Options, they imply a move of plus or minus 7%, again in the 24 hours following the release. And interestingly, actually, recent post-earnings performance has been pretty strong, with the stock ending the session following the quarterly report in the green for the last 4 quarters in a row. This time consensus expects, well, EPS at $1.03 and on revenues of 148.78 billion. Just on the technicals, I should just stress, so you can see here, this is Meta stock. You can see we've got this line from the gap higher at around $453, so just below the current price. Then you've got the 200-day moving average, the black line at 431, and then this swing low at 414. Otherwise, the all-time high is at 542.81. Amazon, just off its highs, around $200. You can see strong resistance there. Looked as though it's going to break that, but didn't. And then we've fallen down below the 50-day, and the 100-day moving average was toying with. So that's a 184.07. And yeah, just watch out for that. There's a swing low here from last week at 176.80. Otherwise, then we get to this major swing low, really. From April at 166.32, which is just below the 200-day moving average of 167.81. So some clear lines there for Amazon. Apple as well, as I said, they report after the closing bell on Thursday. Tomorrow, they're up around 17% or so year to date. It's obviously, well, the biggest stock by market cap now, I think, still. Or currently at the moment at least. It is also a Dow constituent. And derivatives, well, they see a move of around just above 3.4% plus or minus after the release, potentially in the 24 hours after the release. That's what they're pricing. Recent pedigree post earnings really kind of mixed. Last quarter's report being the first in 4, after which Apple had ended the day in the green. Consensus expectations see EPS at $1.34. That's on revenues of 84.4 billion. And you can just see the stock here with the again the all-time high at 237.23. You've got the 50-day moving average just below at 210.86, and then these swing lows at 206.59. Those are the major levels. Let's get to this week's data. At least now we had just released the eurozone inflation data. I'll just pull up a graphic with that first of all, which is here. Just checking you can see that. Yes, so eurozone inflation data important for the ECB, of course. Expectations were for headline to decline to 2.4 from 2.5%, but they came in at 2.6%. And then the core print, always important for policymakers, that was seen pulling back to 2.8 from 2.9%, but stayed at 2.9%. Interestingly, actually, core inflation had beaten consensus in 5 of the 7 flash estimates since the start of the year. We also have, well, we put on here the services inflation print as well. That was previously at 4.1%. I just need to check whether that is now, but that is obviously a key number for ECB officials as well. So we didn't really get the small pullback in price pressures that markets had hoped for, really. And it's kind of marginally dented the odds of another rate cut in September. They stick around sort of 65, 66%. So a touchdown from sort of 68%, which money markets had priced in for that September rate cut. Just remember, though, we do get one more inflation report, so that's probably why we haven't seen a major reaction here at the moment. We'll just move on to, well, we'll just look at euro dollar actually now, which is here and sticking around the 200-day moving average. You can see the black line and the blue line actually is a 50-day moving average. So 200-day at 108.22, 50-day at 108.10. So you also have a fib level here, which is from this high in December to the low in April, and the 38.2 is at 108.06. So 108 around that level is a key support level. If we break probably the 100-day moving average at 107.93, sorry, then we're down towards the next fib level, maybe at 107.28, and then below sort of 106.80 are these June lows, which acted as support, which after which we got a decent bounce up to 109.48. That's euro dollar then. So slight bid after those slightly marginally stronger than expected inflation numbers. Bank of Japan then, let's get to that. Key meeting just finished really. They raised rates to 0.25%, as I said. That was really against consensus and market pricing as well. The BOJ also announced bond purchases will be nearly halved to around 3 trillion yen by Q1 26. Rate hike really does mark quite a big shift in policy now, where policymakers really putting a greater emphasis on the longer term inflation projections, which are now seen above 2% in the financial year 2025. The statement also stressed the inflationary risks of higher import prices, where the impact of a weak currency is greater. Generally, the report really supports the view that we're now seeing the normalization of the Bank of Japan policy, and that potentially will accelerate in the coming months. Governor Ueda, as I said at the top of the webinar, his comments were relatively hawkish, so he was quite open to further rate hikes, stating that the Bank of Japan will raise rates again if growth and inflation move in line with the bank's forecasts. I'm just checking, actually, there was really interesting, actually, a slight mistranslation actually in one of the headlines when we were following it, with Governor Ueda saying initially the Bank of Japan don't have 0.5% policy rate in mind, but then that was seen as in mind as a ceiling. So really interesting, quite hawkish remarks from Governor Ueda in his press conference after the statement and the decision to hike rates. Initially, interestingly enough, we got a bid in dollar yen, as I said, and that was probably down to, well, positioning really. Some structural position probably lingering in the yen, as speculators might have seen the rate hike as a near-term peak for the yen, and really an opportunity to enter sort of carry trades around that 152 key level, which we've highlighted here. You can see it was the previous intervention level in October 2022, and then we didn't get an intervention in November 23, but you can just see that was a huge level which held again as well before then we fell. So interesting, yeah, we got the bounce first of all in dollar yen, but then Governor Ueda's hawkish comments really saw that level taken out sharply, as well as the 200-day moving average of 150.162. So we're now down to these are old fib levels that we were looking at, but yes, next major fib levels at 148.68 or so. So really interesting move to the downside in dollar yen, so upside for the yen, and a really important meeting, we think. The key reasons for that sort of importance really are that potentially it's a structural change really on the picture of carry trade positioning, especially if the Bank of Japan remains hawkish and potentially hikes by another 25 basis points by the end of the year. Of course, the carry trade, that's been where investors have borrowed in low yielding the yen and then bought higher yielding assets and currencies. And if that then is now looking to be unwound because the rate differential between Japan, between the US is now narrowing, certainly with the Fed potentially cutting rates as well as then the Bank of Japan hiking, then potentially a lot of those trades which have been funded by the carry trade will then be reined in. And that's what we're seeing, as I say, in growth stocks, potentially in gold as well, and other profitable trades. Beyond the sort of near term, I guess the yen really does look on more solid ground now, and we do get FX intervention figures released by the Ministry of Finance later today. That said, potentially intervention figures don't mean as much anymore, because now we are certainly on a downtrend for dollar yen. You can see we are overbought on the daily, so just watch out for some correction potentially, but certainly the direction of travel is for lower prices in dollar yen and the yen firming up. And I probably need to check other crosses like Aussie yen. You can see collapsing now after making those overbought highs really, and all of these yen crosses now. Interestingly, Swiss yen, you can see overbought and on the 200-day moving average. If we look at euro yen, same thing. Through the, but very oversold, these are, but still doesn't mean we can't go further. That's sterling yen, so you get the picture. Yen strength for sure, and it's just be interesting now what comments we get from some of the Bank of Japan officials as well, and whether they are as hawkish as Governor Ueda has been earlier today. Interesting, we do obviously have those major events today with the Fed, and then payrolls on Friday. That potentially will determine this direction for dollar yen near term at least, but certainly this break of the 152 level is significant, and that will then act as initial resistance to any upside, of course. Interestingly, we note as well markets have trimmed their yen shorts in the past couple of weeks, meaning that net positioning may no longer look too stretched for speculators seeking really structural carry advantageous yen shorts. Interesting whether that is the case or not now with this turn by the Bank of Japan potentially. Okay, let's go to the Fed now, and the graphic with all the main numbers. No changes are expected, so rates will be kept at 5.25 to 5.5%. Decision is in between the June and September forecast rounds, so there are no dot plot updates of rate expectations. The Fed's pretty much widely expected, I think, to pretty much lay the groundwork for a September rate cut at this meeting. Consensus slightly divided on how much they do say or not, but policymakers certainly expressing increasing confidence really that inflation is on the path to 2% and that economic challenges are more of their focus. The data also expected to point towards policy easing, employment costs potentially moderating. They're out today, I think, an important leading indicator for wage growth, that is, and what the Fed looks at as well. That's the ECI data out today. We've seen business surveys cooling, and of course we get the all-important jobs report on Friday, but it has been showing increasing slack really in the labor market. All that said, well, the FOMC may want to express some flexibility to assess really 2 more rounds of CPI and 1 more PCE report, plus 2 more jobs reports between now and the September meeting. There is certainly this soft patch really in core inflation with a few months of soft readings, but rate cutters, well, have they got now truly greater confidence in making progress towards that 2% target? We could see possible tweaks to the statement if we think they have. So the opening paragraph, whether there's been modest further progress towards achieving the 2% inflation target, or something that signals more confidence. And then later on in the paragraph, later on in the statement, sorry, whether there's a reference to the committee holding off on rate cuts until it has gained greater confidence. Whether those words are changed, if you look out for those, then potentially we will get the market moving. Money markets, they have, well, here we are, fully discounted a 25 basis point rate reduction in September. Additionally, markets fully priced the Fed cutting rates again by the end of the year, assuming as well around a 50% chance of a third rate cut. And there are only 3 meetings after this one today. The 2.5 basis points, 2.5 rate cuts or so is obviously in stark contrast to the Fed's June economic projections. If you remember, the median dot plot only penciled in 1 rate cut, really. But assuming things pan out as markets expect, then likely probably see the Jackson Hole Symposium at the end of August. I think it's the 22nd. Just watch out for those 2 words, really, and that will gain in importance potentially, because then the Fed can reevaluate their outlook, really, and then tee up more significantly the rate cut in September, because then they will produce their median dot plots and potentially then cut their growth and inflation forecasts while raising their unemployment projection as well, potentially, in those September dot plots. Just let's look at the DXY index now. If I just pull up the chart, which is here. Remember, the euro has a big weighting in this index, around 56% or so. So just remember that when looking at this chart. But the 200-day moving average, the black lines at 104.31. You've got a fib level at 104.26. That's the halfway of this move higher. So interesting whether we find any support here. Otherwise, then we're at these swing lows around 103.65, which then tally with, sorry, that wasn't the halfway point. The halfway point of the move is around 103.50. We're on the 38.2 at the moment. So lose that, then we're down to, this level here around 103.60 or so. And then the upside potentially capped by the 50-day and the 100-day moving averages, which are at 104.86. We'll quickly move on to the Bank of England meeting now and just pull up another graphic for you, which is similar to the Fed one. So all the main numbers here. Probably a more interesting meeting, really. So we've had the hike from the Bank of Japan, hold from the Fed, and potentially cut from the Bank of England. Markets, they're pricing half of a quarter point cut. So essentially a 50-50 coin flip, really. But Bloomberg consensus is more convinced that a cut will be delivered. I think around 70-75% of forecasters do expect a 25 basis point cut on Thursday. The lack of recent communication from BOE officials sort of does give it more uncertainty, really. Though we do know from the last meeting that the June decision, of course, to hold rates was finely balanced. So if you just think about the MPC, its 9 members, 7, including Bailey, opted to hold last time around, so 7-2 split. The 2, Dingra Ramsden, obviously preferred a cut. So of the 7 then, if you think 2 or possibly 3 are more resistant to cuts, then that leaves sort of 4 or 5 in the middle who could go either way. Have they changed? That is key. We've only heard from a few hawks, Mann and Haskell, really, most recently, although we did hear from Chief Economist Hugh Pill, who said, I think we have to be realistic about how much any 1 or 2 releases can add to our assessment. That was a while ago, so it'll be really interesting what they have to say now. Of course, data since the last meeting, well, doesn't really offer clear support for a cut either if the MPC remains more skewed towards data dependency over forecasts. So that's a big question as well. GDP, well, that's been solid, really, 0.7% in Q1, 0.4% month on month in May. Core CPI, that's been running a little hotter than similar months in history, really. And then services inflation, key number for the MPC, that was at a reading of 5.7% against the MPC's forecast of 5.1%. Although I know economists have been saying that is down to a spike in hotel prices, but even then it would still be above the MPC forecast. Just one thing to note there actually is that core services inflation has actually fallen more aggressively this year, and that's pretty much on the MPC's recent forecast. So possibly they may take that into account as well, much more. Wage growth as well, the other big sort of issue for the Bank of England, that remains pretty warm. The headline rate was at 5.7%, I've got here. while PMI data, composite manufacturing and services, all still in expansionary territory above 50. So yeah, interesting meeting for the Bank of England for sterling. Markets, well, if we just look at this, services inflation is in the blue, 5.7%, wages as well, the yellow line, 5.7%. Then you've got the benchmark at 5.25%, and then obviously headline, which is grabbed all the headlines, but down to 2%, but it's really not what the MPC look at. They look at services and wages. Those are the key numbers, and why there is hesitation over potentially the bank cutting rates on Thursday. If we just look at cable, been pretty resilient, really. Obviously, we come off this high at 130.44. We're just possibly holding on to this previous spike high from June at 128.60 or so. We're just below that at the moment. So you've got the blue line, the 50-day moving average, 127.83. We've got the next fib level, which is between this high and low. You can see at 127.57. So yeah, will be interesting whether they cut, but then give very little guidance, and they want to be really, really flexible. So really then we're not following a sort of traditional rate cutting path, if you like, which is what most banks have been stressing. Then potentially, yeah, we get a sort of hawkish cut, if that makes sense. Sounds slightly odd, but yeah, if they do cut and then leave their options very much open, then whether we'll see a major impact on sterling, probably not in that instance. If we are set for more rate cuts after Thursday, if they do cut, then yeah, sterling will struggle and will test those lower levels, 127.57, 127.83. No cut, then obviously 128.65 comes into view, and then 129 and above, certainly. Okay, finally, let's look at the non-farm payroll numbers. They are released on Friday. Again, a graphic with all the main numbers. Consensus expects 185 as the headline number. That's against 206,000 in June, against a 3-month average I put here 177,000, and a 12-month average actually of 218,000. So cooling slightly, but very gradual job gains cooling, which is interesting. Unemployment rate, that's expected to hold at 4.1%. That's against the June median projection of 4%, but that was for the end of this year actually. Just one point of note, I guess many economists have sort of recently noted, or they're citing the SARM rule. Somebody in Bloomberg has identified the fall in the unemployment rate being a potential recession signal. So basically, a recession is signaled once the unemployment rises 0.5% above its low for the previous 12 months. But there's a big caveat to that, is even if the unemployment rate continues to rise, say by another 0.1% in July, the SARM rule, well, it's unlikely to be triggered because the earlier low, if you remember, of 3.5% in July 2023, that drops out of the 12-month comparison and then is replaced with a higher value of 3.7%. So really we'd have to get a number of 4.2% in the jobless rate to trigger that SARM rule, which is then known as a recession signal. Otherwise, wage growth, average hourly earnings there set to print probably at 0.3%, pretty benign month on month in July. But I've mentioned that we will be looking as well at the employment cost index. Those numbers are released today, which is probably the Fed's more favored wage gauge, really. And that series rose to 4.5% in Q1. So just watch out for signs of whether that is declining. That could be important. We've got just a chart here with those numbers. So you can just see headlines gradually falling while the unemployment rate picks up. And I think we'll wrap it up there. Been through a lot going on, of course. Those earnings to watch out for, then the Fed, then the Bank of England meeting. We also have ISM manufacturing data actually out of the US, which is always quite interesting, leading indicator, as well as then Apple and Amazon reporting after closing bell on Thursday. Before then, this non-farm payroll report to wrap up a really hectic week on Friday. Great having you all on the call. Really appreciate you spending time to tune in. We will speak to you in a few weeks' time. Take care.